Building wealth doesn't have to be complicated or overwhelming. In fact, with the right approach, anyone can start creating passive income streams even if you're a complete beginner. Today we'll break down the essentials of dividend investing, showing you how to make your money work for you. Whether you're looking to supplement your income or lay the foundation for long-term financial security, this playbook will guide you step by step. Let's start by understanding the basics and why dividend investing is a powerful tool for building wealth over time. You invest in dividend-paying assets, you unlock not just one but two powerful streams of wealth. The first is capital growth. The value of your investment increases as the company grows. The second is dividend income, regular cash payments you receive simply for being an owner. This means you're not just waiting for prices to rise, you're getting paid along the way. Let's see how these two streams work together to accelerate your journey to financial freedom. Capital growth is the increase in value of your investment over time. Imagine buying shares in a company that steadily grows its profits and expands its business. As the company becomes more valuable, so do your shares. This appreciation can significantly boost your wealth, especially when combined with the steady income from dividends. It's the classic buy low, sell high strategy, but with the added benefit of earning while you wait. Dividend income is the cash you receive just for owning shares in a company. Many established businesses share their profits with investors through regular dividend payments. This means you're earning passive income, regardless of whether the stock price goes up or down. Over time, these payments can add up, providing a reliable source of income that can be reinvested or used as you see fit. Every investment journey begins with a single step. Imagine your friend Ash wants to build your city's first dog arena. To raise funds, he splits his company into 50,000 shares at $20 each. You believe in his vision and decide to buy 250 shares for $5,000. Now you own a 0.5% stake in the business. This simple act of buying shares makes you a part owner and set the stage for both capital growth and dividend income. Let's fast forward. Ash's business is a success and the dog arena becomes a local favorite. Over the next 10 years, the value of each share rises from $20 to $50. Your initial $5,000 investment is now worth $12,500. But that's not all, you've also been receiving cash dividends along the way. This is the magic of combining capital growth with dividend income. Your wealth grows in multiple ways. As the business thrives, your shares appreciate in value. This is capital growth at work. The longer you hold on to quality investments, the more you benefit from the company's success. Over time, this can turn a modest investment into a substantial nest egg, especially when paired with consistent dividend payouts. Reward early investors. Ash decides to pay a dividend with a 4% yield. For every $20 share you own, you receive 80 cents in cash dividends each year. This means your investment not only grows in value but also puts money in your pocket regularly. Over time, these dividends can be reinvested to buy even more shares, accelerating your wealth-building journey. Instead of putting all your eggs in one basket, you can invest in an ETF, a collection of great companies bundled into a single investment. This approach spreads your risk, so if one company has a bad year, the others can help balance things out. ETFs also save you time since you don't have to research every individual company. It's a smart, efficient way to diversify and grow your wealth. One of the biggest advantages of ETFs is diversification. By owning a basket of companies, you reduce the risk that comes with investing in just one. If a single company struggles, the impact on your overall investment is minimized. This makes ETFs a great choice for beginners and experienced investors alike. Researching individual companies can be time-consuming. With ETFs, you don't have to spend hours analyzing financial statements. Instead, you can invest in a professionally managed fund that does the heavy lifting for you. This frees up your time and gives you peace of mind, knowing your money is working efficiently. Ready to get started? Here's your strategic blueprint. Step 1. Research and select the right investments. Step 2. Invest with consistency. Step 3. Compound your growth by reinvesting dividends. By following these 3 steps, you'll set yourself up for long-term success and financial independence. The first step is to research and select ETFs with a history of stable growth and reliable dividends. Look for funds that have consistently rewarded investors over time. This foundation will help you build a portfolio that stands the test of time and market ups and downs. Building wealth isn't about timing the market, it's about consistency. By investing a fixed amount regularly, you take advantage of market ups and downs, buying more shares when prices are low and fewer when prices are high. This steady approach smooths out volatility and helps your portfolio grow over time. The final step is to put your dividend earnings back to work automatically. By reinvesting your dividends, you buy more shares, which in turn generate even more dividends. This compounding effect accelerates your wealth building and helps you reach your financial goals faster. When it comes to researching ETFs, your best friends are online resources like Google, Yahoo Finance, Morningstar, and ETF.com. These platforms provide valuable data on fund performance, dividend yields, and more. Start by searching for the best performing dividend ETFs to build a solid foundation for your portfolio. One of the most important metrics to consider is dividend yield, the income you earn relative to the share price. Aim for a sweet spot between 1.5% and 4% for a good balance of income and growth. Too high a yield can be risky, while too low may not provide enough income. Performance history is another crucial factor. Look for ETFs with a consistent record of long-term growth and stable dividend payouts. This track record shows that the fund has weathered market ups and downs, giving you confidence in its reliability. It's tempting to chase high yields, but be careful. A dividend yield that looks too good to be true often is. For example, Two Harbors Investments once offered a 16% yield, but its share price dropped by 80% since 2009. High yields can signal a company in trouble. Stick with ETFs that have a consistent history of performance. A huge dividend yield can be a red flag. It might mean the company is under financial pressure and could cut dividends or lose value. Always check the fund's history and avoid being lured by numbers that seem too high to be sustainable. Let's look at SBYD, the SPDR Portfolio S&P 500 High Dividend ETF. This fund tracks the 80 highest dividend-paying companies in the S&P 500. With a yield over 4% and an ultra-low expense ratio of just 0.07%, it's a cost-effective way to earn passive income. To generate $500 a month, you need to invest about $135,000 in this ETF. SBYD's low expense ratio means you keep more of your returns. For every $6,000 invested, you pay just $4.20 in fees per year. This efficiency, combined with a strong yield, makes SBYD a popular choice for income-focused investors. Next, let's explore VYM, the Vanguard High Dividend Yield ETF. This fund offers broad exposure to large-cap U.S. companies with above-average dividends. Its yield is around 2.5%, and the expense ratio is just 0.06%. To earn $500 a month, you need to invest about $240,000. VYM balances income and capital growth, making it a solid choice for long-term investors. VYM has been active since 2006 and has proven its stability through major market events like the 2008 financial crisis and the 2020 pandemic. Its ultra-low expense ratio keeps more of your returns in your pocket, and its consistent performance makes it a reliable foundation for your portfolio. SCHD, the Schwab U.S. Dividend Equity ETF, focuses on companies with a long history of paying reliable, growing dividends. Top holdings include Coca-Cola, Chevron, and Cisco. With an expense ratio as low as 0.06%, it's one of the most cost-effective ways to invest in dividend growth. SCHD's dividends have grown by an average of 5.8% per year over the last 5 years. This means your income stream can outpace inflation, helping you maintain and grow your purchasing power over time. It's a great example of how dividend investing can protect and grow your wealth. Next step is to build wealth through consistency. This is where dollar-cost averaging comes in. By investing a fixed amount every month regardless of market conditions, you remove emotion from the process and steadily build your portfolio over time. This approach helps you buy more shares when prices are low and fewer when prices are high. Let's say you commit to an automatic transfer of $500 each month into your chosen ETF. As your income grows, you can gradually increase this amount. This method ensures you're always investing, no matter what the market is doing, and helps you avoid the pitfalls of trying to time the market. Consistent investing removes emotion from your decisions. Instead of worrying about market ups and downs, you stick to your plan and let time do the heavy lifting. Over the years, this steady approach can lead to impressive results, helping you reach your financial goals with less stress. Now let's talk about automating your growth engine. You have 3 choices for what to do with your dividend payouts: reinvest automatically, reinvest manually, or take the cash as income. Each option has its benefits, but for most beginners, automatic reinvestment is the simplest and most effective way to build wealth. The Dividend Reinvestment Plan, or DRIP, automatically reinvests your dividends to buy more shares of the same ETF. This puts your growth on autopilot, compounding your returns over time. For beginners, DRIP is highly recommended because it's simple and effective. With self-reinvestment, you take dividends from one fund and use them to buy shares in another. This approach increases diversification and gives you more control over your portfolio. It's a good option if you want to spread your investments across multiple funds. The third option is to take your dividends as income. The cash is deposited directly into your bank account, giving you extra spending money or helping cover expenses. This is a flexible choice, especially for those who want to supplement their income in retirement. You don't need to start with a complicated portfolio. The key is to take action. Begin with one ETF that you understand and feel confident about. For example, SCHD is a strong choice for its history of growth and yield. The important thing is to get started and build momentum. To begin investing, you'll need to open an account with a trusted brokerage. Popular options include Fidelity and Schwab. If you're in the US, consider using a Roth IRA for tax advantages. Setting up your account is straightforward and only takes a few minutes. Once your account is set up, transfer funds and make your first purchase. Start small. Buying $500 worth of shares is a great way to build confidence and get comfortable with the process. Remember, it's the consistent actions that lead to long-term success. Every big achievement starts with small, consistent steps. By researching one ETF, setting up automatic investments, and reinvesting your dividends, you're laying the foundation for long-term financial security. Over time, these habits will compound, turning small beginnings into significant wealth. Let's recap the three-step dividend playbook. First, research and select quality ETFs. Second, invest consistently no matter what the market is doing. Third, compound your growth by reinvesting dividends. This simple strategy is the cornerstone of building passive income and achieving financial freedom. The best time to start building wealth is today. The earlier you begin, the more time your investments have to grow and compound. Even small amounts invested regularly can add up to significant wealth over the years. Don't wait for the perfect moment, take action now and let time work in your favor. It's normal to feel nervous about investing, especially if you're new to it. Remember, you don't need to be an expert to get started. Focus on learning the basics, making informed decisions, and staying consistent. Over time, your confidence will grow along with your portfolio. Dividend investing is a long-term strategy. The real power comes from patience and persistence. By sticking to your plan and letting your investments grow, you'll be amazed at what you can achieve over the years. Remember, wealth is built over decades, not days. Reinvesting your dividends is one of the most powerful ways to accelerate your wealth. Each time you reinvest, you're buying more shares, which generate even more dividends. This cycle of compounding can turn modest investments into substantial wealth over time. The simple, consistent actions you take today, researching ETFs, setting up automatic investments, and reinvesting dividends, are the building blocks of your long-term financial security. By following this playbook, you're giving yourself the best chance at a secure and prosperous future. Once you're comfortable with your first ETF, you can start exploring how to allocate your portfolio across multiple funds. Diversifying further can help you balance risk and maximize returns. Keep learning, stay curious, and continue building your investment knowledge. You've now got the tools and knowledge to start your journey toward building passive income with dividends. Remember, the most important step is simply to begin. Stay consistent, keep learning, and watch as your wealth grows over time. Your financial future is in your hands. Make it a prosperous one.